Well, hello and welcome, everybody. It's midweek update time. It's the 11th of May. Joe with you here. Let's jump into the markets. We're going to discuss some things to look at. I'm going to give you my 2 cents. As always, you guys can go ahead and follow along, take responsibility for the outcome, and we'll go from there. So, let's get into what the markets have done. Let's do a quick recap since the beginning of this week, the end of last week. So we've been seeing a pretty consistent slide pretty much the day after the Wednesday announcement. The Wednesday announcement came out. The markets decided to push higher. I'm not sure if that was short cover rally, so on and so forth. But since then, have done nothing but just roll over and fall apart. Which, let's talk about it. It was expected. I think everyone's been talking about a correction. The markets are going to pop. The bubble's going to burst. Blah, blah, yada, yada. We've heard it, and I do think it's deflating very rapidly. So we are seeing active selling in a lot of those higher flyers. And it's funny to listen to Corey talk about it sometimes because he picks on those ARC stocks and the stay at homes, some of the Coinbase stuff, some of the NFTs, things of that nature, which is kind of funny. But they are the overinflated areas and they are actively falling apart. In fact, folks, I was taking a look at this week's moves to the downside when it came to sectors, and you'll see the tech sector and the communication services or consumer discretionaries. Oh my goodness, 10%, 12% down for the week. So we are seeing active selling, and yes, it is coming out of some of those higher flyers. And yes, the numbers aren't good moving forward. We had some earnings, not good, not projecting better, so on and so forth. Very hard to justify some of the stock prices that are out there. All healthy. This is neat. Now, the CPI on the economic side, CPI is lower than previous, but higher than expected. So it's this interesting thing of we're falling apart. Last time this was out was at 8.6% year over year. It's at 8.3. That's showing that hey, at least we're kind of showing a top here when it comes to inflation. However, the expectations for 8.1. Now that's the year over year. Going from quarter to quarter, it's a little bit different. I've got the numbers. We'll take a look at it. So the markets, you're not sure how to take that. I mean, going from 8.6 all the way down to 8.3, that's like, okay, you're going to lose your arm, but you're only going to lose it from the shoulder, the elbow down instead of the shoulder down. It's horrible. That was a horrible analogy, but folks, it's this isn't good. But it is showing that, hey, maybe we're peaking when it comes to inflation. So economic growth is slowing, but it's still steady. That's an interesting thing that I wrote there because it's just, I want to call it stagnant. That's a better way to say. It's not nearly keeping up pace with the inflation, but we are still growing steadily, almost stagnant when it comes to the inflation level. So it'd be nice to see everything kind of turn at once for a little bit softer of a landing than a bubble burst. All right, so let's take a look at some of the trades that have been bouncing around from last week with our class here. Some of the end of days that we've been seeing around the community at Maverick. BMY, OXY, Coca-Cola actually hanging in there pretty good. Then we got PM here on the neutral side. I'm going to give it a neutral to a +1. We'll take a look at the chart here in a second. DHI from last week. Great trade suggestion, folks, as it's rolled over and it's fallen apart. It still looks good for a continuation to the downside. W and run. So let's go through these briefly. This is Bristol Myers, and it is holding into this nice high base. This has been a really cool trade for someone that wants to throw out the diagonal spread, a butterfly, something sideways to up, that needs to hedge out a portfolio that's probably pretty much exposed to the bear side, knowing us over the last couple of weeks. So just one to look at if you're looking for something to stay strong, especially, not to show my hand here, folks, but I just believe that we are in bounce area for the rest of this week, if not going into next. So if you're looking to take advantage of a little bit of a move to the upside with this bounce, it's nice to see some of these stronger stocks, throw a couple bucks at it and see what it does over the next week or so. OXY is another one. Occidental Petroleum. These have been doing pretty good. It's in the correct sector. It's a defensive sector. It does pretty well when bubbles burst, or I should say, well, at least the tech side is starting to deflate a little bit. We're starting to see a little slowdown in real estate as well. So some of those fringe areas are really starting to collapse, and these are a flight to safety, and it's in the right spot. So I like today's candle, to tell you the truth. It's a nice little confirmation so far. I mean, that could change by the end of the day, but I'd be a little bit more comfortable with a break above 65 on this one, but sideways to up if you want to throw it out there over the next day or so to take advantage of what could be, I should say could be, a bounce in the markets. And then good old Coca-Cola. This thing's been pretty defensive. I didn't know if it was going to bounce last week, but it did. And I love that candle about 5, 6 days ago. But it didn't really blast back up to the 67 and a half, close to the 68 mark or whatever, because it just doesn't have the motion of the ocean behind it. These markets are super bearish. The sector itself is good. Consumer defensive is decent, but it's got some anchors in it as well. So it's just holding in there. So something sideways from there. Now this is PM. This is our first sideways stock, and I do like it as a sideways. However, today's candle's kind of promising. It's above the 100. It's above the moving average there, the 20-day moving average. It's been jumping around, right around between the 20 and the 50 for a few days, but pretty decisive candle to the upside. I'd like to see where the volume finishes with this candle, if it could stay this high, but an easy target at 105 if we get a market to move up over the rest of this week, maybe into next. And yes, folks, after sell-off as big as we've seen, remember, Corey loves to tout this, the biggest bullish moves you're going to get are in bear markets. So we could see 6, 7, 8 straight up days. Gosh, that being said, we could see this roll over tomorrow. However, this would be nice to throw out there. So if we do get 5, 6, 7, 8 straight days, at least you're in something to kind of hedge out some of the bears that you're going to hold for this bull pullback, or bear rally, excuse me, is what I should call it, overall markets. So this is DHI. Love it. It looks like it was confirming yesterday. Good confirmation today. Last week when we were looking at it, we were discussing it as a breakdown between below 70. It didn't get there until yesterday, and it's looking really good today. So this is still got a chance. So if you guys are looking to get into something to the bear side, today's the day. It's looking pretty good, depending on your outlook, how long you want to go from here. It really depends on what you have in your portfolio. Understand, my expectations are for a bounce. Maverick's been sitting on that expectation for a while, actually pretty much the end of last week and into Sunday, saying that we should see some selling, but we're definitely going to establish some sort of consolidation or bounce. And so far today, it looks like it wants to. Now, day's not over yet, so if this is something you want to get into the bear side, and I'm not, the bounce doesn't happen, it rolls over, you'll be happier in it. But it's a good little bear trade. Another one is Western Union. This had a gap, and it seems to be trading on the lower side of it. It didn't really retest the gap, so you can see it didn't fill it. It actually kept it open. We refer to an open gap as it actually should technically go back up to this area, but you could play closes and opens is fine. Gaps down, establishes a range, and now it's at the bottom of this range. A closed gap would be if it came all the way back up to, I believe, this area, right? And then it's a closed gap, which also could be bearish, but this one is staying right there, so it's still an open gap. And if this could break or bleed below the 1650, when I snapped into this chart, it was cool because I still left this open here, so you can see that that's a pretty good target when it comes to previous support for the shorter term. So nice little bear trade there. Let's move into the last one. This is Run. I think Rob was talking about this yesterday. It's been on a bear watch list ever since it rolled over and it confirmed this nice little pivot here. I liked it when it started to break below the moving averages. At support, breaking through support is once again a much stronger indication of breakdown or bearish move. So I like it. If it could get below these two levels here, it looks like it wants to fall. The volume is drying up a little bit, but it could be reluctant as, when these do break, if you get a pretty good move in volume as well, it's awesome confirmation that it could just fall apart. Kind of like the markets do, right? You break support, big flush out comes, everybody in their dog starts to sell. There you go. All right, so that's what we got as far as some of the trades floating around the community. Let's get into our market analysis, and these are some of these numbers that I thought were very interesting. Taking a look, well, the sectors are more interesting. However, I figured that a lot of these would have retraced a little bit more. It is only one day. Dow's still down almost 2%, SPY over 3, Q's almost 6. So they're still really bad, considering that the last couple of days looked more like consolidation days. It's just that we fell so quick on Monday. Well, we fell quite a bit there on Monday, and we've been doing nothing but kind of dancing back and forth. You can see the strong is oil there, in oil being a little bit, did I get that to the upside? Yeah, a little bit of a bounce, as well as it's a flight to safety. So let's get into these. Here's that consolidation going on. Let me change my pin color. I don't like green. I want to go red. Let's get a little bit more danger, right? Okay, so we've got the gap down on Monday, and it comes trading back up. We also get a slight gap down, or excuse me, I got those backwards, folks. It gaps down, trades down, closes lower. Then it gaps up. And I thought, okay, this could be that first test bounce. Yesterday failed. Corey made mention of the fact that, hey, you know what, it was a pretty good move. It's off of the low, but it's still ominous. Today looks a little bit more optimistic, but keep in mind, folks, this also gapped down. So let me start this drawing over so I can get rid of these chicken scratches. So here's the close from yesterday, right there-ish, and we gapped down to here. A little bit of a slide in the morning, but we're climbing back up. Now, if this could finish somewhere in this area, I would not be surprised to see a retest of the 410, maybe up into this level here. Let me get a straight line if I can. There we go. Maybe 410, 415. I would not be surprised to see that at all. However, we'd need a pretty good push towards the end of the day on the bull side or a short cover rally to actually start that. Overall, it would be best if you want to look at the probabilities of the chart that it actually is probably going to stay somewhere between this first range that is established after the gap. Remember, folks, gap, open gap, it retraces where it closed from that first established candle, and then it kind of stays there. So that's going to be the higher probability. A break above this, I could see a retest of the 410, maybe even back up to this 415. The bull or the bear rally that I was just talking about a little bit ago. Overall, guys, let's go to the diamonds here. Not much to really make or change your portfolio exposure or make massive decisions on. None of it is. Being net bearish makes total sense. It still does, even through the bear rallies. Yeah, it's going to hurt some of your bears. We just looked at a couple of bulls. If you want to throw those on shorter term for the next week or so, it could take a little bit of the heat off. A lot of times, guys, you can actually go out to the ETFs, the spiders, the diamonds, the Qs themselves, if you want to hedge out a little bit over a little bit of a bear rally, or the next week or so. That's for you guys that are late May expirations, June, so on and so forth. So here's the diamonds. It's in the same situation. These have all broken support levels. All of them have, and they look to be establishing a slightly lower low. The diamonds here looks like the low is not nearly as deep as the SPY. I'm going to go ahead and skip ahead because it's very similar to the SPY, but the Qs is a little bit more ominous, and it has broken its major support. Actually, it did last week. It's pretty interesting because these sneak up on you. If you don't pay too much attention, you figure, oh, the SPY, so on and so forth. This actually broke support from last week and established a lower one. What was that? 1, 2, 3, 4, 5, 6, 7, about 8, at that point. So last week it broke, set a lower low, which is the arrow I just drew, came back, and it's now setting a second low. The other two markets haven't done this. So this is a little bit more bearish. This is substantially more bearish. Does it mean it's due for a bounce? Of course, but there is a lot in this market, or the tech side specifically, that's been leading this charge for 2-3 years on communication services, technology, that have been super overinflated. So I would not be surprised to see this continue. I don't think it's going to be as aggressive to the bear side as it has been. This might be a slow taper, but it does have a little bit more to give up. A love opinion, right? You have to listen to it. Take it, leave it. It's fine. So let's take a look at some economic reports. Got the wholesale inventories, consumer inflation, year over year, 1 year consumer inflation expectations over 3 years. Folks, I've touted this many times on these trading rooms and midweeks over the 2 decades that I've been working in the markets. When something is focused upon, you're going to get more and more and more economic indicators for it. So inflation is definitely the biggest thing in the world right now. Now you have consumer inflation for the year, for the 3. You got projections. You got the consumer price index, which was quarter to quarter. Now it's year over year. So you're going to get all sorts of different micro and a little bit more macro looks at this because it's now a very, very hot topic. So keep that in mind. Once inflation subsides, these will go away. How I know this is there was a huge oil thing with the first oil crisis, so you want to call it, where we had the futures manipulated and oil got up to $147 a barrel, I believe, maybe $150. We had inventories, oil inventories, reserves, production. I had like 8, 9, 10 numbers of oil each week. It got pretty annoying. So we're at that level where this is super high and hyper focused. We talk about this in Maverick. When everybody freaks out, When everybody's super hyper focused on something, that's where bubbles burst. So just a little heads up for anyone who's new to the markets. Let's get back on topic here. So the consumer inflation for the year went from 6.6 to 6.3. That's a good sign. For over the longer term, it actually ticked up, and that's the confusion that a lot of traders are saying. So the CPI itself, 0.4%, comes at 0.6. That's hot. The initial reaction on that should be panic-inducing. When you smooth it out with the CPI year over year, it's at 8.3%. Now, the expectations were for a drop at 8.1. This came down from 8.6. Once again, hey, you're going to lose your arm, but you're only going to lose it from the elbow down instead of the shoulder down. It's one of those things where it's still a problem. It's not good, but it's enough to let the markets so far today bounce. All right, jobless claims, continuing claims. We've got that whole job quits. I think that's kind of an interesting number as well. We'll see where that goes. The PPI, I think, is going to follow suit with what we see in the CPI. It'll probably have a year over year. It's going to have its quarter, so on and so forth. Keep that in mind. Consumer sentiment. We got the 5-year inflation expectations that the University of Michigan's put out as well. We're going to have all sorts of inflation data moving forward. What really matters, folks, is the reaction the markets get with these numbers. And more importantly, what the Fed sees in the numbers and what they're going to do with these continued rate hikes. That is probably going to have the biggest impact on the markets. All right, let me step off my soapbox. Let's get into, if I can find it, there's the poll. I want to poll the class here and see what you guys are thinking. Now, I believe that we've been pretty bearish. There we go. Is that launched? Yeah, good. We've been pretty bearish over the last couple of weeks. Makes total sense, right? I'm expecting a pretty decent bounce. I'm not sure about the other guys. I hadn't had a chance to talk to them this week, but based on some of their videos, I believe they're thinking the same thing. So it's one of these ideals of, are we at the bottom yet? I think it's pretty easy to say that no. I think we do get one more flush out. However, technically, due for a wonderful bounce. All three of the markets are at lower levels where they could establish support and even bounce. So consolidation, bounce over the next few days, to me just makes total sense without trying to influence your guys' votes. Keep that in mind. So as traders, what does that do? Well, we're going to have to compensate for that. And I'm totally fine with throwing a couple of bullish darts out there. I don't want anybody out there fishing from bottoms. Please don't try to buy GameStop or AMC right now. And hey, these guys are going to go back up to 500. That's such a rookie move. However, some of the things that have been doing strong, like the first few charts that we looked at, energy sector, consumer defensive, things of that nature, yeah, absolutely throw a dart. Go for it. So it might help over the next little bit. Okay, we stalled out. Not a lot of people voted today. 86%. That's okay. And let's go ahead and share it with everybody. And it looks like we are just sitting flat. Makes sense. Slightly lower. 0 to -1 is what I'll give today's class. Total sense. Makes total sense. The midweek is a tough class some days because it's always midweek. Number one, it's usually over. All Fed announcements are on Wednesdays. And then number two, it's midweek. Right? We're usually in the level of a correction, whether that's bullish or bearish. All right, guys. Thanks for voting. We're moving on. I am playing the probability of the chart itself. So I'm a +1 for the rest of the week. I see these last 3 days. You guys can see that chart there, right? I see the last 3 days. I see a little bit of a green candle. Whether that stays there or not, I think that we actually float towards the 410. If I'm wrong, I don't care. I'm not changing my portfolio stance, and I am not abandoning any bears because overall my monthly outlook still stays at a -2. It could be a -3. The reason why I gave it a -2 is because I'm expecting, the probability of a consolidation or bounce or a retracement to 410 is very high. Just playing the odds. That's all this is. All right, guys, thanks for your participation. Let's get into the sector analysis, which just shows there is so much to give up. And I do believe over the years, I want to talk months and months ago, I made a statement that I thought was kind of funny. And once again, I don't know if it's going to happen. We're going to see these markets sell off, and traders are going to say they can't possibly sell anymore. They're down 20%. They're down 30%. They can't possibly sell anymore, and they will. I've seen it too many times. So when I see some of these numbers, let's just take a look at them here. When I see we're down 12.99, almost 13% in the consumer discretionary, and 10%. This is for the week. This is from Wednesday to Wednesday in technology. I mean, my goodness. Yeah, there is still more there because when you take a look at the chart and then you take a snapshot of it over the last couple of years, there's a lot out there. So that's kind of where we're sitting. Utilities is holding on with a slight loss. Energy second, so on and so forth. You guys know the drill. Nothing's really changed that way. So utilities is the strongest. Consumer cyclical is the weakest with that 12, almost 13% drop, I should say. So let's take a look at these charts. Utilities looks like a bull pullback. It does. A very aggressive one. We've got the 50-day moving average still sloping higher. This would be a zero as far as a chart goes, right? Price action below both moving averages. One's sloping up, one's down. It's be pretty much a zero. Now, if it could get its head above, let me draw my straight line here again. If it could get above that 72.50, we'll call it. Well, let's go to above wherever that 50-day moving average is. I think that'll be the strongest. Then I could make a strong argument that this will slowly probably try to climb its way back up in there. It's utilities. We can't really do much without them. So move on to the next, which is consumer cyclical. Now I pulled the IYC, folks, because the X, I got XLP, which is consumer staples, and I think this is a better representation of the discretionary. Yes, folks, that's an open-ended conversation. It can be argued, and I would never argue anyone's choice of ETF because there's literally hundreds of them and they're all pretty darn close. However, I chose the IYC just because I like the representation of how bad this is. It's gone straight down ever since that Fed meeting, and seeing what's going on in today's market, this isn't even participating in the bounce today. Just barely, pretty much flat, and maybe it's higher now that I've been talking, but you could see it's got this huge falling knife kind of a feeling to it. So we'll see. All right, we are almost done here. Let's get to a conclusion, and then let's go out and take a look at the markets. Let's see who's written down some stuff. Okay, we got a few to look at. So the markets look to be establishing a lower support level at this right now. Now, I could be completely wrong after this class. We could turn red and fall apart, and it's still going down. That's fine. Eventually, these markets will find a point to establish some sort of support. I'm hoping it's sooner than later, and why I like the word hope is because it would be neat to see it so I can make the moves and make my money, right? We want to make money on the bounce, make money when it retraces, falls lower, so on and so forth. The longer it just kind of chops around, the longer I have to sit in cash. Rob made mention of this not only yesterday, but on Sunday. We're okay sitting in cash if you don't want to participate in a bull pullback or some sort of consolidation. It's all right. We'll wait until it rolls over and gives us the higher probability of a trade to the downside, right? So weakness continues. Bearish defensive is the sentiment. That's the best I can come up with. I'm seeing selling in the right places, and I'm seeing buying in the right places. And what I mean by that is my outlook on the markets. What I love about us is you just trade your personality. You trade it the certain way that you can. You put your best foot forward. So when you see opportunity, you take it. So inflation remains an issue. Fed remains hawkish. I haven't changed this much at all. Economic growth is flattening. I figured that was better than shrinking. I don't want to cause any panic because there are signs of growth, but it's not growing nearly as fast as it needs to stifle inflation. I think that's why the Fed is starting to intervene. Long story short, folks, no matter what happens, the Fed's going to be blamed for it. You watch. I love it. They did it too soon. They did it too late. They did it too much. They didn't do it enough. Anyways, that'll be fun when we get there. Okay, let's get out to the live markets and take a look at what we have to add to this class. Oh, looks like we had the promise of moving higher and we're floating over, right? Nice little start out of the gates, but little bit on the weak side. That's all right. That's all right. There's just not a lot of good news out there. I mean, folks, that CPI number was not great and it wasn't horrible. So it's just basically, okay, what does the market do? Well, take a look at the sentiment. One thing that I love to put focus on is the majority, these big companies here, are going to lead the way. If you take a look at the defensive side, energy, basic materials, utilities, even real estate's hanging in there a little bit. Even financials aren't doing so bad. It's your technology, it's your communication services, consumer discretionaries, all the stuff that's been leading the way for the last couple of years. Okay, here we go. Let's start with Scott. Scott's got some trades. KNX and SPY on the bear side. Nice trade. Look at this. Boy, it's pretty strong. Knight Swift Transportation Holdings. Boy, if that can break some support here, that could be something. What do we mean by that? Well, let's get the pen out. If it could break this, where to establish that support, you can see it's a little bit more specific than that, or it's a little bit more. It's happened in the past. It's a pretty decent level for this. So, you see these 2 day. It's okay. It's set 2 higher highs, 2 higher lows. It's above the 50, or I should say above the 20, but below the 50. I do like that slope as well as this one. So great confirmation on this would be a move below. What do you guys want to call that? 47.5. Yeah, I like it. I like it. Thanks, Scott. SPY is the next. That's so cool when we can trade the ETFs themselves. It makes things a lot easier. Yeah, SPY. I have to agree. Boy, this candle is fizzling out. Here I am toting a bounce. We might not get it. We might not get it today. However, if it does start to roll over, this helps sometimes. I've been doing this lately, especially when markets start to break into, I should say, breaking recent support levels. We tend to lose track of the overall, right? So I just want to make sure that when you zoom out, it puts it in different perspective. But yeah, I could see a breakdown. This could fall. We could hit the 380 mark, start to revisit maybe the 360 area, so on and so forth. So absolutely, I'm with you on this. Now on the bull side, yep, PM, of course. We looked at that already. I'll pull it up one more time. Philip Morris is just looking good. Once again, this was the sideways trade, but I like it a little bit more as a move to the upside. Target of 105 on the short term. If you wanted to do something like a credit spread, that might be kind of cool. I'm totally with it. Looks good. So 105, if the markets continue to move higher or if they're going to bounce, as reluctant as that's looking now, it could reach up to 106, 107, 110, up that area. So very nice. You know what? I'm going to put PM down again so we can carry it over from this class to next. Cool. We'll keep it on our watch list. And then XEL. Energy. Same idea. Good support level at the 72. Looks pretty decent. Consolidation, sideways to up. Even with the corrective market, folks, if we roll over today and break to lows, I just see these stocks, some of the ones we looked at already, just floating towards the downside. So butterflies, horizontal spreads are great. Horizontal spreads are awesome. I've thrown a few on, and the markets don't do what I want, and they bleed off a little bit. You still make some money. What sucks is if it shoots up really high, and then you make a little bit of money. You're like, oh, I wish I would have diagonalized that or something, so on and so forth. But that's not what we play as hindsight. But I do like XCL as well. Very decent little defensive play. Thanks, Scott. Awesome. Oh, I like NEM belly flop, huh? All right, Joe. Let's take a look at it. Support at 66, a bear put. Yeah, what's neat about this is you've got a pretty decent. You know what? I didn't do this on the last couple, but let me do it here. I want to zoom in a little bit, make it a little cleaner. But what you have is a nice range that is starting to be threatened or broken. And I like basing stocks that break. And this has done it on its way up. Keep that in mind. This is based, it broke up, based, it broke up. Through here, it mostly ranged. So as it's starting to slide, it's trying to hold on to that 70. It really looks like it wants to. But I don't see anything keeping this from falling straight to 65. I'm totally fine with that on the bear side. Right? Once again, it's a mining company, so we kind of associate it with gold. But it has its own production problems. It's got staffing. It's got salaries, payrolls. It's got all sorts of different things, not just the commodity it mines. So a lot of these don't do as well as, let's say, if gold takes off. Doesn't necessarily mean this will. It's been a pretty steady company. It's absorbed a lot of stuff lately, but yeah, I like it. I like it as a bear. Thanks, Joe. Okay. Do I have the right? Sell bonds. Sorry, folks, I'm reading. Okay. Portfolio, do I have this right? When they sell bonds. Okay, so Scott's asking a question. If we're near market support, has the Fed started selling the portfolios yet? Do they have the right? Okay, do I have this right? He's asking. When they sell bonds, they become cheaper, making yields more attractive, generally increasing bond purchases versus equities. Now, what it is when the Fed buys back debt, it's supposed to stimulate or help banks absorb a collapse. So think of it this way: it's as simple as a bailout. Yes, it gets muddled when it comes to how it affects the interest rates and the yield of the bonds they're buying back and how that becomes attractive to investors, so on and so forth. But let's make this simple as it gets. Literally, the federal government is buying back debt to help banks. That's it. And will in turn, now I don't want to get political, but in turn, the banks will carry that forward to the consumer. It's just easing tension is what it is. Sometimes it works, sometimes it doesn't. It is, boy, Scott, that's like 5 classes we could put together in a conversation we could have for 3 days. But in overall, yes, they're slowing down the buying at this point because they need to put our responsibility back onto us. What that does is it creates strength in the long run, just like increasing the interest rates of the currency. It increases its strength internationally along at local levels. So that's kind of what they're trying to do. So it's one of these things where it's like, you guys have gotten away with jumping on the bed too long. I'm going to start to give you more responsibility. We're going to buy back less bonds. You're going to be responsible for those. You're going to have to start worrying about this. This is going to be put back onto you, which means we don't have the luxury of jumping around the bed and throwing money around, going on vacation all the time. Well, maybe we'll save some money. Maybe we'll, drive less. And it's a way to retract, if that makes sense. Gosh, that was an ugly way to describe it. I apologize if that didn't, but cool thing to talk about. All right. And once again, the joke that I made earlier about the Fed is just always going to be blamed. That's the balance that I'm talking about. If you do it too quickly, it's bad. If you do it too slowly, it's bad. There's no real way to do it without experiencing some sort of pain. Fun question. All right, Scott. Sorry. Let me get going. Even PTON. All right, Dan. Down to $13. Look at that. Wait a minute. Are you telling me that exercise bikes aren't worth $130 a share? What else am I going to hang my laundry on, folks, but the stationary bike in my basement? I don't know where you guys hang your laundry. It's on my treadmill and it's on my stationary. I'm just kidding. All right. Yeah. Now, the funny thing and the sad thing is, guys, I'll just give you a quick back in the day. I watched a company called Taser, which made tasers, do the same thing. I watched 3 or 4 other companies that just don't exist anymore. So yeah, you can go to $130 a share and you can go to bankruptcy in a few years. Crazy, right? But yes, and Dan says, do we need to start checking the book value of these stocks at some point? And oh, Dan, thank you for the topic. This is where you should have been checking the book value of these stocks. That's a bubble. When I first started, 600 times PE ratio, 700 times PE ratio. That's price to earnings to growth. $700 I would give you for you to give me $1 back for the quarter. And people were fine with it. All of a sudden, it comes back to an evaluation that's actually realistic. And hey, whoa. Now this company's got some problems. No. The problems were back here. So there's a fun little consumer example for you. All right, Sebastian, let's get moving. Gosh, you guys are getting me way off topic today, which is too much fun. Is that ABC? Amerisource Burge? Oh, nice. This has been on a pretty good move over the last few days. Sebastian's got a trade here, 160, 162 and a half. Bull call from a bull pullback. 162 and a half. He's sitting in the green. He's just got to wait for this thing to expire. May 20th, not too long. right? About a week and a half. Yep, week and a half. Cool trade. I still kind of like it. Refers to it as a chicken trade. Oh, chicken trades are so great. You know what the funny thing is about chicken trades, folks? If you believe in Murphy's Law, anytime you put less money in a trade, it'll always work out, right? But as soon as you put a full amount of money in that trade, yeah, okay, yeah, you've heard it before. But no, it's actually pretty responsible move. It's pretty funny to see that it's actually today started from your lower strike and has gone through your upper strike. All you have to do is just kind of sit there and sweat it out. But I do like it. Anything moving forward, guys, I'm going to put it down on the bull watch because I do think if this consolidates at 165 and the markets continue to or will bounce or continue, I think this actually breaks up and retests 170. Well, I'm just basing it on the probability. Thanks. Get kicked out of the New York Stock Exchange. Aha. So when does a stock get kicked out of the New York Stock Exchange or NASDAQ? And for example, SoFi is now under $5. It's market cap. A lot of it has to do with the market cap. So even if though it's $5, if they've paid a certain amount of dividends or if they've split adjusted, they can stay in. And most of the time, a stock will be left in. And I know there's different rules between the New York Stock Exchange and NASDAQ. However, it usually is replaced by something larger. So it's not the fact that, oh, we got to replace this because it sucks. It's usually replaced because there's something we can't ignore. Something gigantic is coming and we can't ignore it. The big deal, what was it? Was it Microsoft was tech and now it moved to something else. It's in a different sector even. I think it's in I can't some retail. I forgot. It's more of a retail company than they call a tech. So once a stock gets really big, it needs to be absorbed into one of them. That's usually when they'll kick out the dog, if that makes sense. But yes, there are restrictions to market cap per NASDAQ, New York Stock Exchange, and even the Spiders, SPY. Fun question. Once again, another conversation we could have later on. Let me see Etsy here. Oh, well, Butterfly, 65, 75, 85. Cool, Justin. Let's see. Oh, this has definitely got to be zoomed in too. Okay, moving in. All right, let's draw some lines. You guys know me and my lines. Whoa, I don't know if I can draw them that tight. You got a 60 in there, right? No, 65, of course. All right, so you're somewhere right in this area, I'm just going to guess. Targeted butterfly to the downside. Great. And Justin, if it hits the target, which is going to be, I imagine, 75, the middle point, he's going to just scalp that out. Cool. Totally fine. I'll put it down on the bear side. TSY. Awesome. Thanks, Justin. Fun trade. All right. Let's do like the W butterfly to complete the long-term trend. Cup and handle on W. Let's take a look at it. And it is the 65, 55, 45. I'll have to zoom in on that again. But you still like the pattern, huh? Dan says he's been out of it. He's out of it, but he still likes the pattern. Sure. Yeah, it looks like it's floating. It's going the right way. And your target on that is 55, I imagine. Middle part. Yeah, you're right at it. 65, 55, 45, right around there. Yeah, it's sitting right on it. It's a neat butterfly. I like it as a bear. Let's put it down. I mean, these are volatile. They're large. They're big moving companies and stuff. You see I've zoomed in quite a bit. We're still $20 price points, right? $20 in between here. Just shows you how volatile these are. To kind of what Dan's talking about, what I love about the larger ones, a butterfly is so much easier to absorb when it comes to the day-to-day P&L. When you turn on your computer and you see this thing's up, 5.8, well, down 5.8%. Next day it's up 8%, down 6%. I mean, it really give you a heart attack with a straight call or put or even the shares, but butterflies seem to absorb it really nicely. All right, moving on. MRK. How are we doing on time? Oh, we're great. Oh, nice. Nice. Making a move here. Healthcare. Pretty interesting. They've kind of gone the way. I mean, ever since the COVID thing's kind of played its part, these companies aren't bad. It's not like we stop using drugs and going to the doctor. They're just not as exciting. But I mean, there's a lot of volatility through some of these. Moderna's over the news. Who's the one that just had their CEO do something? So there's a couple that have some push pull. But take a look at what I circled. Gap from here to here, gap from here down to here, gap, drop, I mean, it's all over. But overall, it's doing pretty strong. I'll put it down on the bull for sure. Awesome. All right, guys, fun class today. Great stuff. Let's take a look at what the markets have done since I've been blabbling. All right, just kind of revisited, flat, slightly down. That's still consolidation, still sideways, still counts as it's not a bear rally, but it's consolidation. It's still a hesitation before it takes a breath and maybe rolls over. So I still kind of like my outlook. I still think +1-0, something sideways. If I'm going to throw something on shorter term, it's going to be sideways butterfly, maybe slightly up. Don't be afraid of those calendar spreads, things of that nature. And if it is a strong bounce, like Corey says, we do get some strong bullish moves in bear markets, then we might need to be a little bit more aggressive to the bull side. But I'm not abandoning any bear. No reason to. The time frame that you guys are talking about that I'm seeing seems to be about right. We're not getting too greedy. Just play it nice and steady. All right. And we'll go from there. Bear side. Sorry, guys, I'm typing. You can't see it. Not yet. NAM, TSY, and W. Cool, guys. All right. Oh, quick last question. What do you think your target on Merck? Sorry, could be. All right, let's take a look at it. Well, you could snap some fibos on it. You could draw an ascending triangle pattern on it. Let's see if we can just do something on the fly here without getting too deep. Whoa, that's not the line I wanted. That's not either. I'll take your projections out. Depends on how far you're out. Looks like, what'd you say, the 20th? Week and a half? 92? 92. How's that for on the fly? Although, Sebastian, I like your last trade. You're not shooting too high, so 91? Nah, 92. Nah, that's a pretty good one. All right, my 2 cents. All right, let's do your lists. Here it is, folks. Looks pretty good. I didn't check earnings. I think we're pretty much past it. Triple, double check though, guys, just in case, because I don't want them to sneak up on you and kick you in the face. So, but I like these trades. Good trades. They look pretty decent. The trades we've been talking to the bear side folks have stayed bear, and the bulls have not necessarily broken out anywhere, but they haven't really broken down. So we're on track. It's been great the last couple of weeks. All right, as always, thanks for your participation. If you guys get any questions, you know how to get a hold of us, and we'll see you next time. Bye, everyone.